Hello everyone, thank you again for joining us here. Today we are following up our prior to dividend investing videos and talking about how those dividends actually get taxed and what is often overlooked as that in Canada with the tax credits we can actually get tax-free dividends depending on your income level, and that is going to make your money not only work harder for you but also work smarter, and we're going to increase the efficiency of our investing portfolio. So let's get right to it. We've got a tax spreadsheet here showing in 2021 what are the tax rates in British Columbia. Now, I've chosen British Columbia because that's where I live. Ontario's numbers will be slightly different, Alberta, Saskatchewan as well. This chart could have gone down 10 rows, but we've simplified it to show the first 42,000 at 20% if you're earning a salary, as well as interest income. And American dividends are also treated as interest income, and you'll see in our lower brackets you're at about a 20% tax bracket. And as your income inches up into the $50,000 range, you're closer to 30% here, just under $96,000. You're paying 31% in taxes in BC on your overall income. And as you can see, we go to 117 to 150,000, you're in the 40%. And rather than doing another 5 lines, I've just put anything above that mark will be anywhere from 44 to the top rate of 53.5% in Canada. You're in the top 1%, and nobody's going to feel too sorry for you. But what we're going to look at is the third column is capital gains. We're not talking about that today, but it's usually half of your salary because the government gives you 50% tax-free gains. The weird thing over here is I've got 0% is our tax rate, or -9 or -6%, depending on your tax bracket. These are use it or lose it tax credit. So if your income is in this $42,000 range and you have no other income that you can offset the credits with, you lose your credits. So just for simplicity, we're going to call that a 0% tax rate. But as you can see, like the majority of Canadians are in this $40,000 to $80,000 range. Even if you're paying 28%, your dividends are near zero here at 1.63%. So that's as close to zero as you'll get. And also in the lower brackets, you are at zero essentially. So what you're going to see is as you get into a 6-figure income, the general difference is it's at least 22% lower tax rate for dividends that are eligible from Canadian companies than it is from receiving salary or interest income. And above 150,000, capital gains actually gets taxed lower than Canadian dividends would. But again, nobody is going to be worrying too much about those who are in that tax bracket, but at the same time, there's a benefit to pretty much every income level here, and some of it's important with government benefits, etc. Now, this is for non-registered investing. RSPs will shelter any income you get, so you lose these efficiencies in an RSP or a tax-free savings. That's not a bad thing. So what people tend to do is structure their investments more American and capital gains growth in their RSP TFSA. This is meant for a non-registered portfolio. It could be an inheritance, proceeds of sale from your property. But what we really want to know, really focus here, is on how powerful this tool is, because as much as people do not like paying taxes, here's a way to eliminate 90% of your tax bill on the next dollar of income. So it's often overlooked, but it's right there. It's always been there. I have a chunk of my portfolio in for this reason, because I want to try and get to a probably tax-free income in my retirement years, and I'll be in a lower bracket by then. So now, whose dividends are the ones that pay this low? Everyone asks. Well, it's your usual suspects. These are Canadian companies with our Canadian flag down here. Bell, Telus, I can't remember, these guys are 4 to 5.5% dividends. Royal Bank, throw in TD, CN Rail, Couche-Tard, which is the Max convenience stores. They pay the eligible dividends, which get the Canadian tax credit. And you look at these companies. We'll go back here, and you're getting a 5% dividend. It could be a few $1,000s in a year. You're keeping it. And the key is these companies have already paid Canada Revenue Agency their tax bill. They pay the tax, then they pay you the dividend. If the government were to tax you again, they'd be double dipping. And that's why the government is saying we're going to keep it fair. We're going to give you credit for taking risk because dividends aren't guaranteed. So the government encourages you to take some risks just so probably we won't ask as much CPP or Social Security benefits from the government in the future if we can invest well, right? So again, the usual Canadian suspects. Example of American non-eligible dividends: Apple, Microsoft, Johnson & Johnson. They're American companies. They are taxed at the same rate as a paycheck would be. So because they pay to the IRS, they don't pay the Canadian government tax money, they're paying it to the US government. To wrap the video up, we will go through a quick example. I'm using 28% marginal tax rate. We're using the 6.5% GIC. I know those things haven't been around since probably the 80s or the early 90s. It's just to show the after-tax returns here. So if I was earning 6.5% in a GIC, I would lose 28% of it to tax. My after-tax return would be about 4.67%. And compare that to a 4.75 dividend, probably what Fortis is paying, a couple of our REITs are paying that. Your dividend rate's 1.6, your after-tax return's 4.7. It's much higher than a guaranteed investment certificate, but as we all know, current GICs are only paying 1%. It would take you 5 years in a GIC to get the return of 1 year dividend. And I encourage you to look at the websites of all those companies I mentioned. It'll show some of them have a 20-year history of dividends, 50-year history, 80-year history, 100-year history. In the case of Royal Bank, well, more than 100 years. So, although they're not guaranteed, these dividends grow, so you got a multiplier effect. And, this is overlooked often, but I'm going to recap why is there a lower tax rate. These dividends are from after-tax income. They've already paid their tax from their profits, and there's no catch to it. The government knows what is fair. The credit is going to prevent the double dipping and the double taxation. So if you enjoyed this video, give it a thumbs up. Please subscribe if you find this content useful. We will keep trying to provide some more insights in the future. So I thank you once again for joining us today, and we will talk to you soon. Thank you.